2 billion euros. That is a conservative estimate of what EU consumers lose every year to payment scams. Most of it never returned. The European Union just passed the Payment Services Regulation, PSR, and its partner directive, PSD3. And buried inside those rules is a provision that banks and fintechs have been dreading. When a fraudster calls your customer, pretends to be you, and tricks them into sending money under the new PSR rules, your bank or fintech may have to foot the entire bill. If you work in fraud, AML, compliance, or payments at any EU-facing bank, fintech, or e-money institution, this directly changes your liability, your controls, and your daily job. Fraud and compliance professionals, drop a comment below. Has your institution already started mapping PSR's liability rules to your current controls? I genuinely want to know where teams stand right now. Let me show you exactly what this looks like in the real world. It is a Tuesday morning. A customer gets a call from what looks like their bank's fraud department. The caller sounds professional. They know the customer's name, last 4 digits of their card, and last transaction. They say suspicious activity has been detected and that funds need to be moved to a secure account immediately. The customer is walked through strong customer authentication, the security code, step by step by the fraudster on the phone. They approve an instant payment to what they believe is their own safe account. The money is gone within seconds to a mule account. Then moved again, then it disappears. Today, under PSD2 rules, the bank's typical response is, you authorized the transaction. You entered the code. We cannot be held liable. And in most EU member states, that ends the conversation. Under PSR, that answer changes. If a customer was tricked by someone impersonating the PSP and they report it to both the police and the bank, PSR's default position is that the bank reimburses the full loss. This is not a niche edge case. Impersonation fraud, where criminals pose as banks, regulators, or law enforcement, is one of the fastest growing fraud typologies across the EU, and PSR is designed specifically to flip liability in these scenarios. Before we go further, let me explain what PSR actually is, because a lot of people are still confusing it with PSD2. PSR stands for Payment Services Regulation. It is the new EU rulebook that directly governs how payment services must behave, and it replaces the conduct parts of PSD2. Here's the key difference from PSD2. PSD2 was a directive. Each EU country had to turn it into national law, and they all did it differently. PSR is a regulation, which means it applies the same way in every single EU country, automatically. No national gold plating, no arbitrage. PSD3 is the companion directive. While PSR handles conduct, what you must do, PSD3 handles who is allowed to operate. It replaces both PSD2 and the Electronic Money Directive, merging them into one authorization and prudential framework for non-bank payment firms and e-money institutions. PSR introduces 3 specific changes that fraud and AML professionals need to understand right now. The first is about who pays when someone impersonates your institution. The second changes how payments are checked before they leave. And the third drags online platforms into the liability chain for the first time. Game changer number 1. Impersonation fraud liability. Under PSR, if a criminal poses as your institution, tricks a customer into making a payment, and the customer reports it to police and to you, you are expected to reimburse them. The burden has shifted. The regulation also says PSPs are expected to have appropriate fraud prevention mechanisms in place. That means real-time monitoring, risk-based transaction limits, SCA designed to resist social engineering, and clear warnings at high-risk moments. Get these wrong, and liability shifts further toward the institution. If this sounds familiar, you may be thinking of the UK's app reimbursement regime, which went live under the Payment Systems Regulator in 2024. The EU's PSR is drawing on similar logic, protecting customers from authorized push payment scams, but it is broader in scope and applies to the entire single market. Game changer number 2 is called verification of payee. Before a payment leaves your institution, PSR requires that the payee's name is checked against the account number. If they do not match, the PSP must warn the customer, or in some cases refuse to send the payment. Think about how many APP scams start with someone emailing or texting a victim a fake IBN, an account number under the name of a legitimate company. With VoP in place, when the customer enters that IBN and a mismatching name, they get a warning. The mismatch becomes a red flag. But here's where it gets interesting. Scammers are already adapting. They are acquiring accounts or registering companies with names close enough to trigger a close match rather than an outright mismatch. They coach victims to override VOP warnings. Your UX design and override policy will determine whether VOP actually stops fraud or just creates friction. Game changer number 3 is the one that surprised most banks and fintechs when they first read the drafts. PSR extends the liability chain beyond payment firms. Online platforms, think large social media and search platforms, can face liability toward PSPs if they fail to remove fraudulent financial content after being notified. On top of that, advertisers promoting financial services on very large online platforms must be able to prove they are authorized or legally exempt in the relevant country. PSR is starting to build a wall between scammers and their main customer acquisition channel, paid advertising. For your fraud team, this means something very practical. When a scam starts on a platform ad, you now have a structured legal basis to notify that platform and potentially seek recourse, but only if you built the process to gather the evidence first. Every refunded scam case should also become a platform notification case. So let me recap the 3 PSR game changes for fraud and AML. 1. Impersonation fraud liability shifts to you if your controls are not up to standard. 2. Verification of payee means name-checking before every relevant payment, with warnings and refusals for mismatches. 3. Platforms become part of the liability chain for scam content they host. Now let me connect PSR to your actual systems and processes. PSR does not just change your legal policies, it changes what you need from your technology stack, your customer journeys, and your analytics capabilities. With instant payments at the core of PSR's regulatory world, batch-only fraud monitoring is no longer sufficient. If you are detecting fraud after the money has moved, you are detecting it too late. PSR's liability framework assumes you have real-time decisioning capabilities in place. Here is a point that gets missed in a lot of PSR implementation projects. Fraud and AML cannot operate in separate silos anymore under PSR. The same payment data feeds both fraud liability decisions and AML transaction monitoring. If your two teams are working from different systems and different risk pictures, you will have gaps that supervisors will find. Your customer journeys need rethinking too. VOP checks, meaningful fraud warnings, transaction cooling off options, and easy access to human support, not just chatbots, are all part of what PSR considers a proportionate response to fraud risk. If a customer presses override on a VOP warning, that override needs to be logged, assessed, and potentially escalated. PSR is the conduct piece of the package, but there is also PSD3, and if you work at or with a fintech payment institution or e-money firm, PSD3 directly affects whether your business model keeps its license. PSD3 folds e-money institutions into the payment institution framework. E-money institutions, your digital wallet providers, your prepaid card issuers, become a subcategory of payment institutions with aligned capital, safeguarding, and governance rules. Some firms that operated in gray areas may now need to seek full authorization. For financial crime professionals in fintechs, PSD3 means your AML and fraud framework is now formally part of what supervisors evaluate when deciding on your authorization. It is not a compliance annex anymore. It is core to whether your firm gets or keeps its license. PSR and PSD3 do not sit in isolation. They are part of a larger EU control stack. AMLR, the anti-money laundering regulation, tightens AML rules across all obliged entities. MiCA governs crypto assets. DORA sets operational resilience standards. NIS2 covers cybersecurity. From a financial crime perspective, these all interact with what PSR and PSD3 require. I want to hear from those of you working through this right now. Which regulation in the EU stack is giving your team the most headaches at the intersection with PSR? Drop it in the comments. These interactions help shape where this series goes next. Here is the uncomfortable truth about how most PSR implementation programs are running right now. The legal team is remapping liability articles. The IT team is scoping VOP integrations. Product is updating customer journeys. But fraud and AML teams are often brought in late, after the design decisions are already locked. Fraud and AML teams need to be in the room from day one of PSR implementation, because the liability regime is only as strong as your controls, and the controls are only as strong as your analytics, and your analytics are only as good as your data, and somebody has to own that chain from the very beginning. I have put together a full breakdown of the PSR and PSD3 regulatory texts, with annotated sections on the key provisions at davincidiligence.com. The link is in the description. And if you prefer to consume this on the go, this entire series is available as a podcast on Spotify. Search Davincidiligence. Let me leave you with a practical diagnostic checklist. These are the 7 questions every fraud and AML leader should be able to answer before their institution goes live under PSR. Question 1. Are you ready for VOP across all relevant payment channels? This is not just a technical tick box. Your name-matching algorithm, your warning UX, and your override policy will all influence both fraud outcomes and your liability position under PSR. Question 2. How big is your current APP and impersonation fraud exposure? And what is your reimbursement policy today? If you cannot answer those 2 questions with data, you are not ready to define your PSR response. Question 3. How real-time is your fraud and AML monitoring today? If your fastest alert takes minutes and instant payments settle in seconds, you have a window of exposure that PSR's liability framework will exploit against you. Question 4. Do you have a structured process to cooperate with online platforms on scam content? A documented notification workflow, evidence-gathering standards, and a record of takedown responses are what a mature PSP looks like under the platform provisions of PSR. Question 5. Are your PSR, PSD3, AMLR, Maker, and DORA projects coordinated? These regimes share data requirements, governance expectations, and supervisory timelines. Running them as separate workstreams is how institutions end up with conflicting architectures and duplicated effort. Question 6. Does your executive team have the right metrics to understand PSR risk? Fraud loss rates, reimbursement rates, VOP override frequencies, and transaction monitoring performance are no longer just operational numbers. They are supervisory evidence. Question 7. Is your customer-facing team equipped to handle PSR-era complaints? Under PSR, complaint handling for impersonation and app fraud cases needs to follow a defined process with timelines, evidence standards, and clear escalation paths. This is where many institutions will stumble first. PSR and PSD3 together represent the most significant rewrite of EU payment services rules in a decade. And unlike PSD2, which allowed member states to take different roads, PSR applies uniformly across every EU market from day one. That means if you have EU operations, there is no waiting for your local regulator to transpose it on their own timeline. This video is the start of a complete series. Episode 1 takes you through why the EU moved from PSD2 to PSR and PSD3 and what that structural change means. Episode 2 goes deep into the liability rules for impersonation and app scams. Episode 3 covers verification of Payee in detail, design, matching logic, and UX. Episode 4 covers platforms and the scam ecosystem. Episode 5 dives into PSD3, specifically for fintechs and e-money firms. And Episode 6 covers data, open banking, and AI analytics for fraud and AML under PSR. If this episode helped clarify what PSR and PSD3 actually mean for your work, subscribe so you get every episode in this series as it drops. Episode 1 is already live. It goes deeper into the regulatory architecture behind these reforms. Share this with your fraud, AML, legal, or product colleagues who are still wondering what all the PSR noise is about. I will see you in the next one.